All right, what's going on, everybody? Welcome to the first lesson of this video, of this channel, of this playlist, etc. Um, it's going to be a very basic, overarching, holistic view of what the stock market is, what's going on, that kind of stuff. So, firstly, I'd like to welcome all you new people because it's 2020. So I'm assuming a lot of you have decided to start becoming smart, financially speaking. You want to maybe change your lives and really, quit the whole 9 to 5 thing and go full time on stocks and, you know, earn passive income and stuff like that. Well, for you folks that are out there that are interested in exactly this, I'm I'm gonna have to break that ice for you, but unfortunately, it's not really like that whatsoever. Um, Basically, it can be over a very long period of time, but in the short term, I wouldn't really anticipate being able to accomplish that exact idea, despite what many people have told you. Making $500 a day is technically, actually, it's not 500. It's closer to about 400 something. If you make that every single day for over the course of 365 consecutive days, you would make 100K a year. I think it's actually a little bit less. So because the trading days are open about what is it, 180 days out of the year. So if you take $100,000, which is what the six-figure income is, and you divide it by 180, you'd have to make roughly $555 every single day in order to supplement a six-figure income, roughly. And so that's one statistic that's very hard. If you have a $5,000 account, you would need to earn roughly 10% a day in order to supplement that. If you have $10,000, then you would have to earn 2.5%. And you're going to have to understand that that kind of thing is very difficult. On any given day, maybe a stock, for example, what I'm looking at currently is an ETF. This whole movement, this entire candle, is about a 0.5% move. So it is very difficult to do that, and over the long term, it is hard to achieve receiving more than 1% a day, 2% a day, because you have to understand that when you're doing it at such a rate, I'll show you. If you're doing it at such a rate, so if you do 2% every day over the course of 180 days, you have to have earned, on top of that, it's about 360% over that amount of time, and it's not very feasible sometimes. So one of the benefits of this, though, is that as you grow by 2%, you increase the amount of capital that you have available to you. So after a certain point, there are certain economic rules. One of them is called the rule of 70. Once you reach those points, it tends to double. So you take whatever amount that you're trying to double to, divided by 70. It'll tell you approximately how long it'll take to double something. So that's a very interesting. It's closer to rule of 72, but I highly recommend that if you're really interested into this stuff, then you ought to figure out what all that means. Now, so like I said, it's the new year, it's the new decade, it's an incredible time to start learning new skills. However, this one requires a significant amount of practice and skill. Now, I'm not going to say that it's not possible, because it's 100% possible. And if you're dedicated and smart and capable and confident and disciplined, mostly, you can make this. Even if you don't have to be smart, you have to be disciplined. And honestly, you'll find that if you are smart, you're probably going to do worse in this game. A lot of people who are doctors, engineers, lawyers, whatever, who have a ton of experience in some other field, being good at books and stuff like that, have a tendency kind of to do not as well in the stock market. And you probably hear a lot of horror stories about a lot of people who lost everything in the market and this and that. 90% of traders lose. This is 100% true. However, it's true because of those people. Most of the people that enter are novices in and novices out. They don't ever become good at it. And this is the thing that it requires solvency. There's a quote that means it goes like this: the market can stay irrational longer than you can stay solvent. And what that means is, certain times there are things that happen that don't make sense. What causes this random drop? It could be considered irrational. What caused this to go up? What caused this to come down? There are information that sometimes there is information that backs this, sometimes there isn't though, and that is an important thing. It's a good distinction to make. Now, where we stand here is, if these keep happening and you're betting against them, over the long term you will lose, and that will mean that you will not be able to keep testing your theories because you're going to run out of money. Okay, so sorry, I just drank some water. So that's my introduction to this. Don't expect to get rich quick, but don't expect to not learn something. This is a very, very interesting field, and it can lead you into a lot more interesting concepts over the long term. So make sure to study up. Make sure to kind of realize what you're getting into. Don't expect to make money. Maybe even try paper trading. I'll go over this too, but the brokerage I'm using currently, it's called TD Ameritrade. They're very good. They have a software called Thinkorswim. This is the platform that I'm currently on. This is what I use to do most of my charting. You've seen me use E-Trade and a few others, I think, before. Robinhood is a good one if you're starting out. It's not a good thing for long term. I wouldn't recommend it. They have kind of bad service in my opinion, but their fills are very slow. And I realize this is an introduction video, so those are a little bit complex. So for the beginning, let's talk simple. So let's start with, what is a stock? A stock is a representation, essentially, of a company. So, for example, everyone knows about Amazon. Amazon is this company right here. This itself is not Amazon, but this is the market representation of a buyer's urge to enter in Amazon. Meaning that Amazon is a company founded back in 1998, I want to say. It might have started earlier than that. It started quite a bit ago, though, before I was probably born. But essentially, at the time, when people want to get a part of something, and when a company needs more money to back their ventures, and they want investment money, but they don't want to get private investors, they do what's called an IPO, which is called an initial public offering. That allows a company to be traded on the NASDAQ. NASDAQ is one of the U.S. Main platforms or centers for going through stocks and stuff like that. There's a few others called OTC, which means over the counter. I'll go over those ad nauseum at some point, so you'll hear enough about to know. But for the time being, the NASDAQ is the main one that most U.S. people, and not Canadians, but Canadians sometimes, will trade on. And this is where companies go when they want public funding. So when a person, so let's say Bob thinks that they want, they think Amazon is a good company, they're gonna do well in the long term. So back in 2000, they maybe bought $500 worth of shares in Amazon. Well, at the time, it wasn't worth that much. It was worth maybe $1 or maybe a few dollars. I actually am not far enough into the history of Amazon to tell you these things, but I can. So I'll max this out just to really see what's going on. So this is the aggregation period, max available. Okay, so it's about $1. Yeah. Okay, so back in, it shows the date up there, right up here. Back in 1998, Amazon was going for about, on an average, between $1, which was the low, $1, a few dollars, and then back once we got into 98, it got closer to $6, started popping up and stuff like that. But either way, if you bought 100 shares for $100 at the lowest point, and you owned it here, you would own $200,000 worth of Amazon. That is how that works. And that's good, because over time it can get more, so you can sell your shares wherever you want. But essentially, these are parts of companies. It's like a pie, and you're taking parts of the whole company. So I'll give you a good representation. So for example, this is Amazon. Now, obviously, they're going to always maintain the majority of the company. So they'll maintain 51%. This is very smart if you're trying to maintain ownership of a company, so you cannot get voted out by certain elements. But the rest of this 51% or the 49%, this is sold to the public. And this all has variable costs. So it can go from $1 to $2,000, as we've just seen. Okay, sorry about the handwriting, but yeah, you get the point of that. It's about breaking up a company into parts, and that's what they did, and that's what this represents. This represents the going cost for a single share of the stock, and a market cap, and there's a thing called a market capitalization. I'll get into the more detailed stuff in the next video, which represents the total cost and value of a company. Now, basically, I think I've made it clear that this is all the representation of buying and selling a stock. So, for example, if at this price, which you can look over here to the right, it shows right here, for this platform specifically, at this point in time, people were buying and selling around $1,397 for Amazon. A single share of Amazon costs them that much money. As more people are willing to pay more, the price of a stock goes up. When it goes up, more people will buy, but sometimes you'll start hitting parts where people don't think it's worth buying. For example, if bad news comes out, a bad earnings report, and an earnings report is also something I'll get into later. If these are released and they're no good, then you will see that the company will start to decline on the news, on the stocks, all that kind of stuff. And that's pretty intuitive, I think. I think, it makes sense. More people buy, it's worth more. More people sell, it's worth less. You could imagine it as if it's a cell phone. When you purchase an iPhone 11 for the first time, it's worth maybe $900. But maybe in, maybe 10 years down the line, the phone will be worth significantly more because there's going to be newer and newer phones. So it'll go down. However, let's say you purchase an iPhone and then it's released that they will no longer be making any more iPhones. That's the last one ever made. Suddenly, the value, the desire to get your phone is worth significantly more. So now you would probably be able to sell that phone for $2,000, maybe even $20,000, purely just depending on how this hype cycle works. And hype cycle is a philosophical and theoretical concept, but it's fairly consistent. You've seen it with not companies, but things like Bitcoin, cryptocurrency, stuff like that. So it is fairly interesting to see how things react to stuff like that. But I think apart from that, just understand that a company, for example, like Amazon, became more desirable as they started taking up more space in all markets. They've taken clothing. Diapers.com is a very interesting story. Maybe I'll talk about that in a different video. They've taken up our computers. They've gotten more customers. They've taken up space. They've taken up streaming. They're blowing up all sorts of ways. And as a result, they're worth more and more and more. That's why people are willing to pay. At one point, 20 years ago, people were willing to pay a little bit more. 23 years ago, people were willing to pay only about $1. But now people are willing to pay $1,800. Now, and it's important to understand also, markets do align with real-time data, real-time experience, real-time events. So, for example, during this whole point, obviously people are paying $2,000, but you have to understand that also inflation has gone up, which means the dollar back then is worth significantly more than it is now. So it makes sense that people would pay more. I'm not going to say the dollar hasn't gone up 2,000%, so I'm not going to say there's an equivalence, because there definitely is not an equivalence. That's why the way these charts go, they actually go on this exponential curve sometimes, but that's not how you should be looking at curves. This is your homework if you're interested in doing something like that. Start viewing things and look up what a log curve is. If you start viewing charts on a log curve, it might make a little bit more sense. It might straighten out a bit more. Log curve is basically, it's just a mathematical, I'm not going to get into that either. Honestly, it's not worth it right now. But just look at it on a log curve, do your own math, do your own experience. I think it'll make some sense. So I think that is a good start to this. These are called candles. This is what represents the day for that stock. So I'll give you a really good example. This is a weekly. So let me go to somewhere else. So here is the most previous day for Amazon. Okay, so this was on Friday, January 10th, for Amazon. So red means that it opened up and came down. Green means it opened down at the bottom and came up. Okay, so on this one, we start here at the top of this box, and then it closed. The end of the day, it closed at this part. Green is the opposite. Green means you open here and you close here. Red means you open here and you close here. And that makes sense because red means, so, and what does that mean? If you open green, if you have a green candle, that means the day we started lower and it went up. And so that day the stock went up, right? Okay. And now you're going to ask me, fine, but how do we have lower days like this? How can these both be green? How can these both be green and not move significantly up? There's a lot of movement in between these points. So for example, when you open up here, you can actually see the candle is where the stock has touched throughout the day. So for example, you could make a prediction. You could say that today the stock started here, opened here, and then within the first bit of the market opening, the stock actually came down to 18. So started at 1874, came down to 1863, and then it came back up and it finished the day up here. Now the following day, this one does not account for what's called after hours and pre-market. So when the market is closed, because the market in New York time opens from 9:30 to 4:30, anytime after that is considered after hours or pre-market. Pre-market is when it's right before the market opens, and after hours is right after, obviously. Now, the next day, what ended up happening is the stock at night gapped down. The price of the stock came down. And then it was here, it opened here, came all the way up here, and then finished the day here. And then what happened again? The next day we gapped down, and then we moved all the way up, came up just a little bit, and then finished here. That's essentially how these candles work. So for the red, it's the reverse. So let's try that out. So on red, we opened up here. We went up quite a bit to 1910, and then we came really far down, and then we finished up just a little bit from there. Okay, and again, we have more red days. So how is this more up? Well, we in the after hours, we gapped up, we opened up, we came down, we came back up. So now I'm going to show you this candle, and then I'm going to show you how the day went for this exact candle. So we opened here, so we could assume that the stock probably moved in between before a little bit and then came back up and hit this high, and then came really far down all the way to 1880, and then kind of came up $1 or $2 and finished here. Okay, that's my guess. Let's take a look at how that day actually went. So this is not what you want to look at, because this is a little bit, doesn't have enough data. This is the one we want to look at. So so this is supposed to be January 10th. This day is January 10th. So what did we see on this candle? We saw that we came up a little bit. We came up from we opened up at 1905. We went to 1907, came down to 1880, finished up at 1882. So if we go to this day, you can see it happened almost immediately. So the market opens up here at 1905, comes up just a little bit, and then it came really far down very quickly. It tried to pull back for the rest of the day. Okay, so here we go. So this is where we started. This is where we kind of hit our highs, and then we hit low, and then we tried to pick back up, and then we hit lows again. And then we tried to pick back up, and then we hit lows again, and lows again, and lows again. We hit 1880, which was the absolute lowest for the day, and then we finished up when it pulled back up a little bit. And this whole day is described in this candle, because this is a daily, right? This is contained in a daily form. So the minutes, the time frames matter. So this one right here is 1 minute. This one right here is 1 hour. And this one right here is 15 minutes. And this one right here is 4 hours. And now I'll go through this very quickly, but then I'll close this out. The reason you watch things in different time frames is because you get different amounts of information. So this one gives you all the data, almost all the data. Not every tick, not every buy and sell, but a lot of them within 1 minute. So if 100 trades are made in 1 minute, you're going to see that on this volume here. So in the beginning, you get very high volume because a lot of people buy stocks at that point. But then it starts to die out throughout the day. On the 15-minute, you see this same drop, but you'll see it from here to here, 1893. So we came here, and we fell here, and that falls in about correctly. This entire 15 minutes is kind of aggregated up till there. And then here you have more data. So these are what I look at when I'm trying to look at a longer term play. So what do I think about this? This one shows me the day. For example, what do I think about how today's going? It's going pretty red. And based on just this, you could say, hey, it's not doing too well. Just buy the shorts. And so I'll talk about what shorts are. But basically, I will talk very quickly in this sense about, I'll talk about just this time frame right here. So when you are doing well, when the stock is doing well, and you want to be part of how well it's doing, what you can do is you can purchase a stock. You can do what's called going long at, say, 1700, and you can hold it up until, you're not going to ever sell it at the highs. It's not possible. But let's say you sell here at 1900. Then if you had one share over this amount of time, so this is in December, and then this, so from December 10th to January 7th, you will have made, what is that? $370? $270. So, I'm sorry, $170. Man. Yeah. So you will have made that amount of money over that amount of time. And this is called going long. Now, let's say you're here and you think that the stock is not going to do well. Then what you're going to do is you're going to go in shorts. This is where you sell the position. I'll talk more in depth to do that, but you'll sell the position here. And then as it goes down, you will make money off the exact amount that it went down, which is the reverse of going long, okay? Longs and shorts are opposites. Shorts are what you do when you want to go down. Longs are what you do when you want something to go up, okay? And I think this will conclude for today. I hope you guys liked the video. I'm going to be uploading more. Please ask your questions in the comments below. I will love to answer them. It gives me more stuff to talk about. This video, I didn't realize it was going to actually go in this depth. So what I'm going to do is I'm going to make more complicated videos. I'll go in longer. So I'll explain actually exactly what short selling is in the next videos. In the upcoming ones, I'll describe as much as I can. Thank you guys for watching. I love doing this, actually. It was very fun. So I'll see you guys next time.